Okay, now can all of you hear me because there has been some voice disruption? Kim, Kabu, Sarah, and Alisa, can all of you hear me? Because the session started at 9:40. So since like 9:40 you are not hearing me? Since last the 14 minutes you're not hearing me? Should I resume from where I resumed right after the break, or should I continue from where I was? Okay, let me restart. Let me restart as if I'm restarting after the break. So let's restart right from the time where I resumed from the break. Okay, now all of you can hear me, right? Okay, that's perfect. Okay, now let's resume from where we resumed after the break. Now, right after the break, we started on with the syllabus area, which is corporate governance, which is the first syllabus area, which is in my domain. And within the corporate governance, we have 6 syllabus areas. The corporate governance consists of agency. The corporate governance consists of stakeholder analysis. The corporate governance consists of governance scope and approaches. The corporate governance consists of reporting to stakeholders, board of directors, and public sector governance. So these are 6 areas which are the breakdown of governance as per the syllabus guide issued by the ACCA examining team. Now, I'll be picking up each of these areas within corporate governance to give you a better insight of what they are basically. I'll be starting first with agency, the first area within corporate governance. But before starting on with agency, I would like to give you an holistic view of what basically corporate governance is, because it will be a bit unfair that I directly start on with agency without now telling you what corporate governance is. I want to make your mindset very clear about corporate governance, which will really help you to understand the 6 syllabus areas. So let's start on with an holistic view of what corporate governance is. Now, when we look at the corporate governance, on my Word file, day one, what is corporate governance? And when I say what is corporate governance is a system by which the companies are directed and controlled. Now, there are 3 very important things to understand corporate governance. First of all, a system. Secondly, directed. Third, control. It is a system. Now, you have to imagine that you cannot run a system. To run a system or to implement a system, you need leadership. Now, leadership is another syllabus area which belongs to me. You need the leadership right to run a system. You need a leadership to implement a system. And we know that leadership who is running this system, who's running the corporate governance system, that leadership is basically the board of directors, is the chairman, is the board of directors. To run the system, to implement the system, we need the leadership, we need the chairman, we need the board of directors. So it is a system. We need the non-executive directors. They are fundamental, right? They're fundamental leadership. They're fundamental leadership of corporate governance. A governance cannot be run without a chair. Okay, the audio has recovered again. So we were discussing that corporate governance is a system, right? And to run a system, we need the leadership. And the leadership is the chairman, is the chief executive officer, is the non-executive director, and is the board of directors. And this leadership is very crucial. So leadership is another syllabus area, right? And see how leadership is connected with corporate governance. Now, when you're preparing for SBL exams, you cannot keep these areas isolated. You need to keep these areas connected. See, we started with corporate governance. We started with corporate governance. All of a sudden, we came across a system, and all of a sudden, we came across a leadership. See how things are connecting. So we cannot run a system, right, without the leadership. And we know that leadership is very important. Leadership is very important for not just running the system, not just for running the system, or not just for implementing the system, that they're more important, not just for running the system and implementing the system, rather plays a crucial part in organizational culture. Now, culture is a part with Mr. Ijaz Khan will take in his syllabus area, but try to understand the leadership. Can without a leadership we run a system? It's impossible, right? Without a leadership, we run the system, we implement the system, we set up a culture. So see how crucial the leadership is. They run the system, they implement the system, they play a crucial part in the organizational culture. Now, culture is yet another syllabus area. So we're just exploring the system, and you've connected two syllabus areas here. System was connected with leadership. System was connected with culture. So the leadership is playing a very crucial part in terms of corporate governance. So it is a system, right, by which the companies are directed, by which the companies are directed. Which companies? Which companies are directed? And the corporate governance says the corporate governance is mandatory on all listed companies. Which companies? Corporate governance is mandatory on all listed companies, and all listed companies are known as outsider system. Please remember this jargon for the future classes. The listed companies in corporate governance, the listed companies are known as an outsider system because in a listed company, the public can buy the shares, the public can sell the shares. So there is an interaction of an outsider system with a listed company. There is an interaction of the public. So the public can buy the shares at the stock market. The public can sell shares at the stock market. So these listed companies are at the stock market, and the stock market is an investment avenue for people to invest. So which companies? The companies listed. Corporate governance is mandatory on all listed companies. Secondly, which companies? Corporate governance is voluntary. Corporate governance is voluntary to all companies within insider system. Corporate governance is voluntary to all companies who are within the insider system. Which insider systems? The one who does not trade at the stock market. The company which trade at the stock market is an outsider system. Please be very clear on the definition. The company which trade at the stock market is an outsider system, right? The company which does not trade at the stock market is an insider system. It is voluntary for all companies within the insider system, which includes the family businesses, which includes the public sector organizations, which includes the private companies, which includes the NGOs, etc. But if a family business becomes listed, if a family business becomes listed, there are so many family businesses in the world which are listed, then that is an outsider system. The moment your share starts to get traded, the moment your share starts to get traded at the stock market, you become an outsider system. But if a family business has no trading at the stock market, then it is an insider system. Public sector organizations, the one which are run by the government. So the public sector organization is an insider system because the ownership of that system is with the government. And there are so many companies in the developing countries, the public sector companies, which have taken listings. If a public sector company takes a listing even, then it becomes an outsider system. But if the public sector company has no listings, it will still remain an insider system. So please, outsider and insider has nothing to do with public, right? Outsider and insider has to do with the share trading. So if your share is being traded, you are an outsider company. As simple as that. And if your shares are not traded, you are an insider company. So family businesses, NGOs, the private companies, the public sector organizations, they do fall under the insider system. So corporate governance is voluntary on these companies. So we got to know the system, who is responsible for system. We got to know the companies, on which companies the corporate governance is mandatory and on which companies the corporate governance is voluntary. And please remember these very important jargons I used here: insider system, because this is part of your syllabus, and outsider system, which is part of your syllabus. So be realistic to that. Okay, then next. Then it says, it is a system by which companies are directed and controlled. Directed. It is a system by which companies are directed. Directed. Directed means to set a direction, to set a goal, to set a target. Companies are directed. Directed for what? Directed for goals, directed for future, to set a target, to set a goal, because that is basically the direction. Now we know who sets directions, right? The chairman, the board of director, they sets the direction, right? So who sets the direction? The direction is set by the leadership, right? To set a direction, who is responsible? The leadership. To set a direction, to set a goal. Now try to understand this. When we say to set a direction, see the three levels here. These three levels are very important. Direction. The level one says, where we are. So when the directors, when the chairman have a board meeting, and in the board meeting they says where we are, that is the present, 2018, September 2018, where we are. And then they have to set the direction, where we want to be, where we want to be, where we want to be. That is your direction. That is your direction. Where we are is the present, right? Where we are is the present. And where we want to be is the future. And then something very important is here to here. The very important thing is how to get there. So this is direction, right? The direction is where we want to be. Where we want to be. We are in 2018. Where we want to be. 2020, 2025. Where we want to be in by 2025. Where we should be by 2025 in terms of our sales, in terms of our profitability, in terms of our market share. And how to get there. How to get there. How will we reach the goal of 2025? How will we reach the goal of our sales, our profitability, our market share by 2025? Now that means, now that means when we are setting up our direction, the directions are of two types. One type of the direction is the long-term goals, the long-term targets. That is where we want to be, where we want to be. And the second direction is and the second direction is how to get there, which is basically known as the strategies to achieve the targets. I hope all of you have a clear mindset on a goal and a strategy. The goal is the target which has been set. Now, how to achieve the goal is your strategies. How to get there, strategies to achieve the goal. Now, see, both of them are important. Your strategies are important, your goals are important. Both of them are important, right? So, is it very, very important for the leadership to make goals and strategies? Because if you only set the goal but you don't have a realistic strategy, you will suffer. So, your goal has to be realistic. And then to achieve the goal, you should have realistic strategies. So, these are two very important parameters, right? How we are directed. So we need goals. Can we say direction is equal to goals plus the strategies? Both of them are important. Setting a realistic goal and setting a realistic strategy. How many times it happens in the corporate world that the goal is very good, but the strategies are so bad to achieve them? So both, there has to be a coordination. There has to be a coordination between both. So a right goal with a right strategy will be success for a business, right? A right goal with a bad strategy is a failure to the business. And how many corporate businesses have failed in the last 10 years, in the last 15 years, just because they didn't had a good strategy or their competitor had a better strategy than the main company. How many times the competitor gives you a tough time because the competitor has a better strategy than you. So are all of you realizing the importance of goals where we want to be and the importance of the strategies? How much time we spend on making our marketing strategies? How much time we spend our time making the sales strategies, the human resource strategies in in every day in the organization? The time is consumed on execution of strategies, making of strategies. So are you understanding the importance of the leadership here? How important the leadership is? Executions, setting the goals, setting the strategies. Right? Before I go further inside, we are left with the last thing, which is it is a system. I hope all of you are clear on system by which the companies, I hope all of you are clear on the companies, direct it. And the last now is controlled. Now, control is my syllabus area again. Leadership is my syllabus area. Governance is my syllabus area. And control is my syllabus area. Organizational control and audit. Now, you know how important controls is for a business, how it is controlled. Now, when you look at controlled, how organizations are controlled, then you need to speak of the importance of controlled. Controlled in terms of what? Controlled in terms of the internal control systems. And you know how important internal control systems are for any organization. How important these systems are. Because these internal control systems have many benefits. But again, it needs a culture. If there is a strong culture, you have good controls. If you have a weak culture, you will have weak controls. Internal control systems. What are internal control systems? Your policies, your standard operating procedures, your standard operating procedures. Every company have policies, right? Every company have SOPs, standard operating procedures. These are internal control systems. Then what is control? Your internal audit department. Your internal audit department, which is very much important for monitoring of the internal control systems. See how important that is. Then you also have the role of the non-executive directors. The non-executive directors. How important non-executive directors are. Because again, the non-executive directors works in committees. So many committees, right? Primarily the audit committee. And the audit committee is so very important committee when it comes to monitoring, of the internal control system, monitoring of the internal control system, and even the monitoring of the internal audit department. Controls are important, right? Controls are important. If I have to illustrate you controls and importance of controls, I'll be illustrating you the controls and importance of controls this way. If you look at the controls, this is how they should look like. The inner circle, the outer, another outer, and then the other outer. I think I'm not very good at drawings, right? But these are four circles here. Within the first circle is the company. And the company is surrounded by three layers. The first layer the company is surrounded with is internal control system, ICS. Internal control system, the policies, the policies. So the very first circle is the ICS system. Then who checks the ICS is the internal auditor, right? Then you have the internal auditor in the second layer. And on top of the ICS, and the internal control system is the non-executive directors, or is the audit committee. Is the audit committee. See the layers of controls. See the layers of controls. Within the most within inside is the ICS. On top of ICS is the internal auditor, and on top of the internal auditor is the audit committee. See how much control is there under the corporate governance, because you want to safeguard the shareholder investment. You want to safeguard the principal. Why are we directing it? Why are we controlling it? Because we need to protect the shareholder, which is the principal, Okay, let's recap. Controls. Now can we say controls number one, number one controls is equal to ICS plus the internal audit department plus the audit committee. That becomes the controls. And please remember, the audit committee is the custodian. Audit committee is the custodian of the overall internal control systems. Overall internal control systems. So who has the oversight? The audit committee has the oversight of the ICS. Is that clear to everyone? So these are holistic pictures you're getting currently. Let's make one last holistic picture this way. If I say there is an if I say there is an audit committee, under the audit committee is the ICS. Under the audit committee is the ICS, and the ICS comprise of two things. The ICS comprise of the system, the policies, the system and the policies, and the ICS comprise of the internal auditor. Okay, the effort I'm doing here is just to give you a holistic picture of my syllabus. This will all be counting in the next classes to come. This all effort will go into accumulation of the syllabus later. You will start to believe this importance in the coming classes. So is everyone clear how important AC is, the audit committee, the oversight of the audit committee, and how important function the audit committee plays? So the audit committee is sitting on top of the ICS, and the ICS comprise of the systems and policies and the internal auditor. So are you getting this holistic picture? And are you understanding some glimpse of controls you have in your syllabus and some glimpse of what you will be learning in the topic organizational control and audit, which is a syllabus area. So I have given you the summary of organizational control and audit, which will come later. Please hold this summary with you carefully. Okay, so let's go back and wind this up. So now we know everything, right? Corporate governance is a system by which companies are directed and controlled. Now comes the topic, agency. Corporate governance is a system by which companies are directed and controlled. Now that brings me to my main topic. And the main topic we're starting is agency. So agency becomes the first topic within corporate governance. Now, when we explore agency, please understand one thing carefully. We just got the definition that corporate governance is a system by which companies are directed and controlled. Now, I'll change the context. I've given you the breakdown of system, companies, direction, control. Now, see how I changed this line to agency. Is a system by which companies are directed and controlled. And now I says it is a system which is run by the agents on behalf of their principal. It is a system which is run by the agents. I'm using agents in plural form here, right? On behalf of their principal. It is a system. Which system? You just understand that system above, right? Now I'm saying the system is run by the agents on behalf of the principals. Who are the agents of the system? The agents of these systems are the directors, the chairman, the, the CEO, the non-executive directors, the external auditor, the internal auditors. They're all agents, right? They're all agents of the principal. Some of them, some of these agents are responsible for direction. Some of these agents are responsible for control. These are agents, right? The principal incurs the cost of all these agents. The cost of all these agents are deducted from the operating expenses. The fees, the fees, the fees, the salaries, the wages you give them to your agents are deducted from the operating expenses, right? That means it is deducted from the principal profit. So agents, there are so many agents, right? You just came across. Now, some of the agents are responsible for direction, and some of the agents are responsible for direction, and some and control. The agents are responsible for direction and control, right? The agents are responsible for direction, where we are, where we want to be. They're responsible for directions. They're responsible for setting goals. They're responsible for setting the strategies. And they're responsible for controls. They're responsible for check and balance. Check and balance. They're responsible for monitoring. Why? Why? Because at the end of the day, there is a principle. And what is the principal wish? What is the principal wish? The principal wish: maximize the wealth, maximization of wealth. Safeguarding shareholder interest. If you are a principal of a company, if you are an owner of a company, is that what you expect from your agents? That your agents maximize your wealth and the agents bring success to your company and safeguard your shareholder, safeguard the shareholder wealth. There should not be any fraud in the company. So see the agents. What are the agents doing? The agents are working for directions. And the directions is giving them what? The directions is giving them the directions are giving them what? The directions are giving them maximizing the shareholder wealth. The directions are giving them success of the company. And what control is giving them? The control is giving them safeguarding. The control is giving them the safeguarding. Is that clear to everyone? So is the system run by the agent on behalf of the principal? Is that true? And the agent is responsible for direction and control. Direction brings the wealth, direction brings the success, and control brings the safeguarding. And whose wish is that? The shareholder, the principal. Now, I think I've explained you this system in many contexts now. I first explained you the system in the context of leadership. Then I explained you the system in the context of which companies, insider systems, outsider systems. Then I explained you this in the context of direction and controls. And now I'm explaining you in the context of agency. But this is the way of the SBL class, right? In the SBL class, I cannot just give you rote learn perspectives. I have to open your mindsets here. I have to bring holistic pictures in front of you. I need to bring open views in front of you. I need to keep the class interactive. I cannot just reproduce a rote learn material in front of you. I need to illustrate you things in the SBL class. So it is a system, right, being run by agents on behalf of the principals. And now you can understand this, right? Now you can understand this. Agency is a relationship. Agency is a relationship between the agents and the principal. I hope you can understand this relationship now. It is a relationship. So is the agent responsible? Is the agent responsible in this relationship? It is a relationship between the agents and the principal, whereby the agent whereby the agent is responsible to work in the best interest of the principal, the shareholders. Is that a true statement? And have you seen the demonstration of that? Okay, any questions so far before I go back to my presentation? Any questions pertaining to the last 45 minutes where we have resumed the topic known as corporate governance? Any confusions, any misunderstandings, any questions you want to raise so far, so forth, before I jump into the next discussion? Okay, is there any questions? At least you can respond with yes and no if you are not raising any questions. So I know you are in the classroom. A simple yes and no can help me out with execution of the lecture. Okay, Kim, Kabu, no questions. Okay, good enough. And you're understanding, right, Kim and Kabu? You're understanding the systems, directions, controls, and everything. And you're understanding how things are linked with the syllabus. Okay, that's great. Okay, so then let's resume further. Okay, now all this exercise will now help me pace up things. I'm going back to my presentation, starting with agency. Now see how easy it would be for you to understand what agency is. In the context of the corporate governance, it is a relationship between the principal and the agent. I've explained that, right? Separation of the ownership of the company from its manager. In a listed company, this is the problem, right? In a listed company, the principal and the agents are two different persons. In a listed company, agency is a problem. In a listed company, because the principal is a different person and the agent is a different person, it brings into account the agency relationship. In a family business, there is no agency relationship, because in a family business, the person who is the owner himself is the manager. In a family business, the person who is the owner himself is the manager. But in a listed company, the person who is the owner is not the manager. So there is a divide, right? There is a divide. And that is the reason the corporate governance is for the outsider system. Corporate governance is not meant for insider system, right? Corporate governance is meant for corporate governance is meant for separation of ownership. And where you find the separation of ownership? You find the separation of ownership in a listed company. So corporate governance is meant for listed companies, right? Corporate governance is for listed companies. Separation of ownerships. So I hope you can understand the separation is in the outsider system. And who is the agent? The agent here is the director. So directors have some responsibilities, right? And I've just justified the responsibilities. They are responsible for direction and control. Direction and control. And if the director fails to fulfill his responsibility, the director would be accountable. Accountable to whom? Accountable to the principal. So the director would be accountable to the principal. So very basic things, right? Very basic things. You must have read them in F1 paper and the F4 paper. Okay, next. Conflict of interest. There is a conflict of interest, right, between the shareholder and the director. The shareholder wants the returns and earnings, right? The shareholder wants profit after tax. The shareholder wants the returns and earnings. The director, the director wants the salary, rewards, perks, bonuses. There is a self-interest of a director, right? The director's self-interest is in the salary, rewards, perks, and bonuses. The shareholder's interest is in the return because he's the owner. He has invested in the company. So ultimately, he needs return on his investment, return on his investment. Now, that means both of them have a conflicting interest. One has an interest of a salary, the other has an interest in the return. So corporate governance says there has to be an alignment of interest between the directors and the shareholders, between the directors and the shareholder. And two ways through which you can have an alignment of interest. One is a performance related pay. Link the pay of a director with performance because the performance is what the shareholder wants. So link the pay of the director with the performance. Link the pay of the director with the performance and give him share options. Give him share options. Give him a share option with like a 5 year vesting period. Give him a share option with like a 5 year vesting period. Because if you give him a share option with a 5 year vesting period and the director wants to exercise the share option after 5 years, he will demonstrate a good performance. He will like the share prices to go up. And the share prices going up is something good for the shareholder. So either you can give the share options to a director so that the interest of the director is aligned with the shareholder, or you can give him a performance related pay because performance is the interest of the shareholder and pay is the interest of a director. Now try to understand something very, very important in terms of performance related pay. So let me go back to the Word file and let start something down, agency. And under the agency, we're starting another topic known as conflict of interest. Sorry, not conflict of interest, alignment of interest. Alignment of interest. Now, there are some suggestions for alignment, right? One of the suggestions for alignment is performance related pay, and the other is the share options. Now, if we explore both of them from the context of the syllabus, performance related pay, corporate governance recommends corporate governance recommends that at least half the salary half the salary of a director should comprise of performance related elements. At least half the salary of a director should comprise of the performance related elements. At least half. It can be more than half. It says at least half. This is the best practice, right? This is the best practice of the corporate governance. At least half the salary of a director should comprise of the performance related elements. Now understand what it is. When we look at the director's salary, the director's salary comprised of a fixed salary, which is known as the basic salary. And this salary has nothing to do with performance. This is without performance. This is your basic salary, right? Which was given to you on the basis of your competence and experience. So the fixed salary or the basic salary has no correlations with your performance, right? But then within your salary can be bonuses. The bonuses have to be linked with performance. Perks. Perks are the privilege the director gets. And again, perks have no association with performances, right? Perks, privilege the director gets. Privilege like car, privilege like house, privilege like free petrol. These are privileges, right? These are privileges the director gets. These are perks. Bonuses. Bonuses are linked with performance. Now, just for example, if I put a table in front of you and I say there are two directors in a company, there are two directors in a company, director A, director B, and the fixed salary of a director A and the perks and the bonuses. If the fixed salary of a director, $1 million, $1 million, if the fixed salary of a director is like $2 million and the director 2 fixed salary is also $2 million, then they have perks, right? They have equal perks. They have equal perks, right? The director A gets a car, the director A gets the housing facility, and the director A gets the medical. And the same is with the director B. Then the bonuses. The bonuses is that based upon the performance, right? Based upon the performance. The director A has a condition. He has a condition that he will get 50% bonus of 50% bonus if the director achieves the sales target. He'll get 50% bonus if the director achieves the bonus, right? And bonus is of what? Fixed 50% bonus is of what? Is of the fixed salary. Is of the fixed salary. And the director 2 B, the policy for director B is that he will get 10% bonus if the director gets the sales target achieved. Now see the motivational level of both. The director A knows that if I achieve the sales target, if the sales target is achieved, this director knows I'll be getting 50% of 2 million. So I'll be straight away getting $1 million as my bonus. At least half the salary, at least half the salary should comprise of the bonus. And see, that's exactly the criteria of corporate governance. But the director B knows that even if I achieve the sales target, I'll be getting 10% of the 2 million. So I'll just be getting another $200,000. Which director will be more enthusiastic in achieving the targets? Give me your response. Which director will be more enthusiastic in achieving the targets? Director A or Director B? The Director A, right? Why? Why the Director A will be more enthusiastic in achieving the targets? Because he's getting good bonuses, right? At least half the salary should comprise of the bonuses, should comprise of performance. So is that a better incentive giving you 50% or more than 50% bonuses? Is that a better incentive to works in the shareholder interest? Yes or no? Is that a better incentive to work in the shareholder interest? So are you realizing the importance of giving at least 50% performance bonuses? At least 50% performance bonuses. So those 50% will drive the director. The 50% will motivate the director to achieve the targets. So which is a better situation for corporate governance? Director A is a better situation, right? This director A is a better situation, right? Not the director B. Right? So I hope you're getting the element of performance related pay. At least half the salary of a director should comprise of performance related pay. That's the best practice. And what is performance related? Bonuses. Bonuses are performance related. And then second, give them the share options. But when you're giving them the share options, give them the share options for a longer period, for a longer period. That means the vesting period should be longer, because longer the vesting period, suppose you give them a vesting period for share options, and the vesting period for share options is 5 years. So 5 years means the directors will demonstrate high performances in 5 years for the share options to vest. So do they want the share options to vest after 5 years? They do, right? So for that, what they have to do? For that, they have to demonstrate the performance for 5 years. So the share options should have a long-term focus, right? You cannot give them short-term share options. You have to give them long-term share options. 3 years, 5 years, directors will demonstrate high performance in 3 years and 5 years for share options to vest. And what will they do? This will uh, this will help the share prices, to go up, which is the interest of the shareholder. So the shareholder would like that. So are you getting the knowledge of alignment of interest? So the director have an interest in a salary. It is better to align the salary with the shareholder interest. The shareholder wants the dividends. The shareholder wants the return on his investment. It is better to align the director interest with the shareholder interest, so that we have a win-win situation. If the shareholder is winning, the director is winning. And if there is an alignment of interest, it will bring very good results, right, towards the success of the business, right? Let's go back to the presentation. So this was the conflict of interest, right? Monitoring. You cannot leave the agent without monitoring, because if you leave the agent without monitoring, the agent can do the wrong things. He can manipulate the performance. He can fabricate the performance. He can window dress the performance. He can window dress the performance to get better results. You cannot leave the agent without controls, without check and balance, because you can imagine yourself, right? If we are without check and balance, if we are without invigilation, we can do wrong things. There should be a check and balance on us, right? So the steps to monitor the director. First of all, NEDs. NEDs should monitor the agent. Then annually there is an AGM, and all of you know how important AGM is. Once every year there is an AGM, and in the AGM, the shareholder interacts with the agents, the principal interacts with the agents, and if the principal wants to hold accountable the agent, they can hold they can hold agents accountable in the AGM. And there can be a one-to-one dialogue, there can be a one-to-one intervention. Let me explain you this. How basically to do the monitoring. And I hope all of you realize, right, how important monitoring is. You cannot leave the agent without monitoring. Can you? Can we leave the agent without monitoring? Yes or no? Can we leave the agent without monitoring? If we do so, what is the implication? What is the implication of leaving an agent without monitoring? What will happen in the company? Fraud? Will the fraud happen in the company? Yes. Will he work in his self-interest? Yes. Will he do frauds? If you leave the agent without monitoring, can you imagine the Enron scandal, which happened in 2001 in America? Enron scandal, where governance has come from. Governance has come from the Enron scandal. Where governance has come in our syllabus of ACCA from the Enron scandal. So all of you realize the importance of the Enron scandal, right? How important the Enron scandal was. And the Enron scandal was an eye-opener that you cannot leave the agent without check and balance. So let's find the ways of these monitorings here. How can we monitor the agent? Monitoring the agent. Now, when we speak of monitoring the agent, there are three ways to monitor the agent. The first way to monitor the agent is NEDs, committees. How many committees are there in the corporate governance? You have audit committee, you have risk committee, you have nomination committee, you have remuneration committee. And all these committees checks the director. These committees will come in the later part of our syllabus. All four of them come in the later part of our syllabus. But all of you have a realization of these committees, right? And you know how important these committees are. So these committee keeps a check and balance on the agents. Who is the agent here? The directors. Then second, AGM. In the AGM, there is a dialogue. There is a dialogue between the shareholders and the directors. And the shareholders can make directors accountable at the AGM. They can reappoint them, or can remove them. We know directors are reappointed each year. So the shareholder can reappoint them each year, or the shareholder can remove them each year if they're not showing good performances. So once every year, the directors are subject to scrutiny. Once every year, the directors are subject to accountability. And then the more important one is a one-to-one dialogue. Who can have a one-to-one dialogue is very important. Now try to understand something very, very important here. One-to-one dialogue. Who is having a one-to-one dialogue? Number one, the institutional investor. such an important part of your syllabus in corporate governance, the institutional investor. All of you should know and realize the importance of an institutional investor. You should realize how important the institutional investor has become in the last 15, 20 years in the stock markets. We are not talking about an ordinary investor like me or like you who must have bought some shares of a company. We're talking about an institutional investor, and the corporate governance has given the power to the institutional investor that he can have a one-to-one meeting with the director, one-to-one meeting with the chairman, one-to-one meeting with the chief executive officer, one-to-one meeting with the non-executive director. The institutional investor is powerful. He has large shareholding, has large shareholding, and the large shareholding gives him the power. Is powerful, has a large shareholding. Now, you might ask me, who is an institutional investor who can intervene so specifically? And I hope all of you know who is an institutional investor. For example, the institutional investors are the mutual funds, the pension funds, the insurance companies, the banks, etc. The mutual funds, the pension funds, the insurance companies, the banks, they're all institutional investors. They invest in a large shareholding. When a mutual fund buys a share or an insurance company buys a share, they don't buy 500,000 shares, they buy bulk shares, 10%, 15%. They take significant shareholdings, right? So who is an institutional investor? He's powerful. He has a large shareholding. And what power does he get? What power does he get? He gets the power of a direct intervention, of a direct can have a one-to-one dialogue with the board of directors, can have a one-to-one dialogue with the chairman, can have a one-to-one dialogue with the non-executive directors, can have a one-to-one dialogue with the internal auditor, can have a one-to-one dialogue with the external auditor. See the power, can have a one-to-one dialogue with the CEO. So he can have an intervention. He can have an intervention wherever he wants to because he's so powerful. He's so concerned. He's so concerned about his investment in the company. So are you understanding these interventions? The interventions can be the committees. The committees can intervene and monitor the directors. Then the AGM, right? The AGM itself can be a subject matter of accountability, monitoring. And then a more important monitoring is a one-to-one dialogue, which is very, very important. So can we leave the agent without monitoring? Not at all. There has to be monitoring. There has to be good amount of monitoring. Is that clear to everyone? Okay, now last thing. There has been an article uh, on the subject matter we are going through, and the name of the article is Organizing Transactions. You can see that on the top of my screen on the right hand side. You will go to the website. The link has been shared with you in the WhatsApp group. Let me show you the website. This is the website which contains articles of Strategic Business Leader right in front of you, the ACCA website. So this is the link I have shared with you. Now, when you go to these technical articles of the Strategic Business Leader, you will go down and you will see many articles. The article 1, number 2, number 3, number 4, number 5, number 6, number 7, 8, 9, 10. You will see an article here, Organizing Transactions. Organizing Transactions. Right, this article. See, this article emphasizes on agency theory. I am giving you the summary of this article. You will read this article after my class ends today. Go to the website, I've shared the link. Go to this article, click this article, download this article, start reading it. So this is the first article, right? All of you should be reading. Okay, better thing I can do for you. Let's open this article, Organizing Transaction. Here it comes in front of the screen, Organizing Transactions. And you have to read this right. I'm taking the link, Organizing Transactions. And I am directly putting on your SBL group here. So you have to read this article right, Organizing Transactions. I cannot do more simple things for you, right? So I'm giving you the access to this article so that you just click, reach it, download it, and start reading it. Okay, let's see what are the key extracts of Organizing Transactions, which has been written. Number 1, transaction cost theory. This article focuses on a theory which is known as a transaction cost theory. We need to understand what a transaction cost theory is. Let's go back to the word file and understand what is a transaction cost theory in the context of the topic we are in currently. So let's understand what is a transaction cost theory. Okay, I'm taking a fresh page again, and we're understanding what is a transaction cost theory, which is coming from the Examiner article, examining team article, which you have to read. Okay, let's start understanding it. Now, when we say the transaction cost theory, and we are in the topic agency, and you will say in the agency topic, what is the transaction cost theory? So let me make you clarify what is the transaction cost theory in an agency topic. Number 1, the directors takes decision. The director takes decisions, right? And who are directors? Agents. And each decision has a cost. Director takes decisions and each decisions have a cost. For example, number 1, procurement decisions. They have cost, right? The purchase cost. Sales decisions. Sales decisions have cost. How many cost is in the sales decision? The marketing cost, the selling and distribution cost, etc. The HR decisions. How many cost is in the HR decision? Recruitment cost, salaries, salary, training cost. Can you imagine how much cost is going down with each decision of a director? These decisions are important, right? They have to be taken. But with each decision, there is a cost. And that is a transaction cost theory, that it says with each decision of a director, there is a cost. So if a director takes a decision, there is a cost. If a director takes a decision of a capital expenditure decision, capital expenditure decision, there is a cost. The cost of buying the assets. So this theory is not saying you cannot take decision. This theory is saying whenever you take a decision, there is a cost, which is very natural, right? But the theory says that the cost should the cost should be minimized with proper decision making. Organizing transaction, we should take decisions, right? But the cost should be minimized. That is the focus of this theory, right? The cost should be minimized with proper decision making. For example, if a director is taking a procurement decision, if the director is taking a procurement decision, the cost is the purchase cost. The cost is the purchase cost. If the director is taking a procurement decision, the cost is the purchase cost of the raw material. The cost is the warehousing cost. The warehousing cost of storing of, of storing the raw material, etc. And many other costs, right? Now, can these costs be minimized? Yes, can these costs be minimized? If yes, how? Now it's your turn. If a director is taking a procurement decision, he wants to buy raw material for the next 6 months. The cost to be incurred is the purchase cost of the raw material, warehousing cost of storing the raw material, etc. You cannot avoid this decision, right? This is an important decision, but can the cost associated with this decision be minimized? We cannot avoid the cost. Can we minimize the cost? If you think yes, can you give me some good solutions? See, do a role play. See, suppose you are a procurement director. If you are a procurement director, what will you do? How would you minimize the cost? Give me your suggestions quickly. Who will give me the first suggestion of minimizing these costs? Start off your SBL paper. Become a decision maker. Become a strategic business leader. Okay, let's see who becomes the first strategic business leader. Okay, Kim is saying buying in bulk. Okay, that's good. Buying in bulk will help us. Help in what, Kim? Buying in bulk would help us in what? Will we get discounts in buying in bulk? And the discounts will save the cost. Is that true, Kim? Yes, the reduced raw material cost, right? And Kabu is saying multiple quotations. That's good, Kabu, because multiple quotations can help us choose the best quality with the least price. That's good. Consider the economic order quantity, Moody. That's a good decision. We should consider, should we buy now or should we buy later? We should be ordering at the right level. We should be looking at that, should we buy now or should we buy later? So very good answers, right? So that means all of you are strategic business leaders. If how, if yes, how? Number one, we can get quotations. We can get quotations and choose the one which offer the best quality with least price, which offers the best quality with least price. So that means we can work on economy of a decision, right? Second, we bulk buying, we can do bulk buying. The bulk buying would enable us to get discounts, the purchase discounts. We can get purchase discounts on bulk buying. So we can do the bulk buying, purchase discounts. But again, the bulk buying would also increase our warehousing cost. So one good thing, one bad thing. Then next, we can buy at the right time. We can buy at the right time. Consider consider the buffer stock. Consider the stock levels. How much is the stock levels? Maybe just in time. Perfect. We can buy at the right time. Consider the buffer stock. Consider the stock level. Or we can also introduce a just-in-time technique, because the just-in-time technique will save cost, will save time of holding, the time of holding the raw material. So ultimately that means that the cost can be minimized. So is the transaction cost theory telling us that the director should not take a decision? Is the transaction cost theory telling us that the director should not take a decision? Or is the transaction cost theory telling us that the director should take a decision but should try to reduce the cost? So what's the emphasis of the theory? The cost should be minimized with proper decision making. And I hope you're getting that track with this example. So can a director takes a better decision, saving the cost, reducing the cost? What will happen if you reduce the cost? Will the shareholder get any benefit of that? Will the shareholder get any benefit of reducing cost? Yes, the shareholder profits will enhance, right? Because of the reduction in cost. So can you understand why the examiner has written an article organizing transaction with agency? Because if a director takes a good decision which reduces the cost, ultimately who will get benefit? The shareholder will get benefit. So transaction cost is the first thing. Now let's say take the second thing. So transaction cost, I hope that's clear to everyone. Tick. Second, market market or internalizing. Market or internalizing. Market or internalizing. And you will say, what is market or internalizing? Market or internalizing. It's so simple. When we say market or internalizing, that's very simple, and all of you must be knowing it. Market or internalizing is to take a decision whether to outsource, whether to outsource or not. Market is outsourcing. Internalizing is to have the department yourself. How many times we take a decision of outsourcing and insourcing? Market. So what is the meaning of the word market here? The market means whether to outsource or not. Is that an important decision of a business? And outsourcing have a cost as well, right? So you have to think which have the cost. Should outsourcing save the cost over insourcing? So the management has to take a decision. Should outsourcing save the cost over insourcing? Should I have my own department or should I outsource the department? Should I have my own internal audit department or should I outsource the internal audit department? So should we have an internal audit department or should we outsource the internal audit department? The management has to do what? The management has to do the cost analysis. The cost analysis with both decisions. Are you understanding what market here is? Market is to outsource. Internalizing is to have your own department, to have it in-house. Internalizing is in-house, right? Have it in-house. And market is outsourcing. Market or internalizing. So does it have a transaction cost, market or internalizing? Is that yes? Is that no? Market or internalizing? Do it has cost? If we have something in-house, then also have cost. If we have something to market, we have cost. So the directors have to do the cost benefit analysis and find out which one is better. So is that a very important decision of a director to outsource or to have in-house? Is that a very important decision of a director? Okay, perfect. So market and internalizing. Third, frequency. Frequency. When we look at the frequency, frequency of what? Frequency of the transaction during the year. Now you imagine there are so many transactions which are so frequent during the year. For example, sales transactions. How frequent sales transactions are? They happen every day. Sales transactions, purchase transactions. Are they very frequent transactions? Salaries, salaries and wages. How frequent these transactions are, right? And see this transaction, asset held for sale. How frequent this transaction is. Or the acquisition of a company. Which one of them are more frequent transactions? Which one of them are more frequent transactions? Which happens on a more regular basis? Right? The second ones are more frequent transactions, right? They're more they're frequent. They happen on a regular basis. But the second, third one are more infrequent transactions. Infrequent transactions. So can you believe that with the more frequent transactions, management will be used to taking good decisions? Because when something is routine, it happens on a daily basis, management is more confident in taking decisions, right? Management will be used to taking good decisions because of because of the routine nature of these transactions. But if a transaction happens once in a year, once in 5 years, then this is very important because the management will not be very the management will not have much experience in these transactions due to in infrequency of these activities. So where the management has to be strong, something which happens on a daily basis, on a regular basis, management knows how to do it and they can save a lot of cost. But if something happens on an infrequent basis, first of all, the management don't have much experience of it. So should they be more careful with the number three, where they don't have experience, number three bullet? Management will not have much experience in these transactions due to the infrequency of these activities. And that means they should carefully consider the cost associated and should carefully consider reducing cost associated with these decisions. Is that true? Are you getting the point of frequency? Any issues with frequency? So some transactions are frequent, they happen daily, so management is so used to them. It is so natural for management. Some transaction happens after such a long time, so the management should be very careful for that and should take a better decision on that transactions, because there are high chances you might take a wrong decision on those transactions and might increase your cost. So the first point was transaction cost. The second point was market or internalizing. The third point is frequency, right? And this is where I'm stopping. Try time to recap. Today was the first online class for strategic business leader exams. In the first part of the class today, we had an orientation where we just had an analysis of what basically SBL is. And I did make very clear to all of you that the course is split apart between myself and Mr. Ijaz Khan. Secondly, we started today with corporate governance, and the very first topic we did in the corporate governance was an holistic view of corporate governance, followed by agency, and we was almost standing on the verge of completing agency. Now, I'll be sharing this Word file I used today shortly in like next 2 to 3 hours on the WhatsApp group, and then I'll be sharing the recording as and when it is available. Now, just a quick reminder, all of you on the WhatsApp group have to help each another. I'll be sharing the link of the recording as it is uploaded on the WhatsApp group. A lot of times student fails to find the link because there are so much messages on the WhatsApp group. So at times the student says, I cannot get the link. I cannot find the link. So please help your other friends on the WhatsApp group to find the link once it is posted. And secondly, I think after 24 hours maximum, you need to check your inbox, because um once the recording is uploaded on the webinar, I have ticked the box that the students will be updated by the webinar platform that the recording is now available and you can view the recording. So you can also make use of your email IDs. Check your emails so that you will be getting regular emails from webinar. You will be getting emails from webinar one day before the webinar starts, even 1 hour before the webinar starts. So please ensure that you're checking your inbox. And when the recording is available, you will get an email from webinar that the recording is available. And if anyone, there are some students who are good on IT and they can access things very easily, and there might be students on the group which are not so good on IT and struggle. So please help your other friends, telling them how to view the recording, how to access the recording. If one of you access it, tell the other one how to access them as well, because it's very difficult for me interacting with you 24/7, right? So I'll be sharing the recordings and the Word file over the day today. And we have the second class tomorrow, Saturday, from 11:45 to 12:45 p.m. Pakistan Standard Time. So I'll be interacting with you for the second class tomorrow. And then from Monday, Sir Rajaz will start his classes. Okay, I'll be waiting for your feedback for the first session of the SBL online classes for December 18 exam. I hope you had a wonderful time today in the live class, and I'll be seeing you tomorrow, and we'll be progressing with more interactions on this topic and the topics to come. I've already shared the links with you. Please ensure that you read through the links and keep in touch on with the SBL resources on ACCA website. I'll be waiting for your feedback on the WhatsApp group about the class today. And it's time to say you goodbye and Allah Hafiz, and time to sign off this session. Okay, Kim, have a nice sleep then. And I'll be waiting for your feedback once you awake from your good sleep. Yes, yes, I can understand that these are the issues with these online classes at a global level, that in some countries it is morning, in some countries it's night, in some countries it might be midnight. So have a nice sleep, Kim. Thanks for being in the live class. And that's all we can have for today. It's time to say you goodbye. Have a nice day, all of you, or have a nice sleep, all of you, and I'll see you tomorrow.